Well, good morning. I'm Elliot Kallen, CEO and President of Prosperity Financial Group, and I want to welcome you to another episode of Meet the Expert. We've been doing these since March 28th. Very exciting what's going on. 2 more left, and then we're going to take a break for the summer and just do short interviews, and then we'll bring this back in the fall because we're just getting some great responses to it. So we brought different experts in the 401k, in the individual market, and so many markets right now, high net worth and individual and Social Security and Medicare. And there are just so many great financial subjects. And we've talked about personal subjects, about motivation with a Navy SEAL, how to get yourself out of bed, get out of those pajamas that people are wearing for the day and pajamas that people were wearing at night. And so now that we're coming to the end of June and people are going back to work, we're in a different category now. People are thinking like, how do I grow? How do I get back to things? How do I start eating out again? How do I start patronizing my favorite restaurants? I'm sick and tired of takeout. I want to eat there. So times are changing for us, even though we are having here at the end of June, a bit of a COVID breakout throughout the country again. Hopefully it's not as bad as the first time, and there's no appetite right now to shut down at all. So welcome everybody. Today we have 2 terrific subjects. We've got a PhD speaking about behavioral finance. In other words, why do people make such bad financial decisions? And we're going to have Rob talk about the mortgage market, what's happening, and so forth. So let me introduce our first speaker. Next week, we are going to continue our behavioral finance discussion. As well as next week, we're also going to talk about what's happening in environmentally correct marketplace, how to socially be correct in your investments. We'll talk about that with the people at Deutsche Bank. So Metin is a PhD. He works for Zacks, a large fund company. He's part of the management team over there. He's a data scientist. He's a behavioral scientist. He's a behavioral finance person. He's got a long list of credentials. So welcome, Metin.
Sure, thanks. So first of all, hello everyone. Good afternoon, and very excited to be here. Thanks for having me. So a few words about my role at Zacks. So I'm a data scientist, and I joined about 3 years ago. And at the time, I thought this would be an ideal way to incorporate basically my background in economics and apply that basically to the world of finance. And one thing, just to give you a little bit of an idea how I ended up in the world of behavioral economics, I was about to say how I ended up in this mess, if you will. One thing that I always thought was very interesting from studying economics from early on was the notion that a lot of economic models assume that individuals are acting in a perfectly rational manner. That is, in particular, I remember from one of my first economics classes, I noticed that we were discussing how individuals are using complex math in order to derive an optimal savings rate for their retirement account. And that struck me as something that seemed highly unrealistic. And I asked my professor back in the day and asked whether that was a realistic assumption. And he was saying, it obviously isn't, but it works very well because the math then just is much easier to solve. And that has been something that has been driving economic models for the longest time. And in recent decades, we have sort of moved away a little bit from this. And the notion of behavioral biases as a concept has entered sort of the mindset of financial and economic professionals. And that is kind of, if you think about it, a little strange, because I always thought it was funny that we called it behavioral biases as if we were all perfect human beings and every now and then we deviated from that a little bit. I think it would be more normal to assume that this is how we operate and that is not necessarily a bias, but that is simply how we function as individuals. So with that said, my role at Zacks consists basically of creating and devising algorithms and quantitative methods that can take advantage of that. That is, we try to do research to understand exactly how markets function, how individuals behave, and what drives particular decisions and particular behaviors or patterns in the market. And with that said, I want to share with you quickly, I'm going to share my screen with you quickly here. So now everyone should be able to see my screen, I hope. Maximize this. There we go. So what I would like to talk about today is exactly the consequences of these type of behavioral patterns. That is, one thing in particular, obviously, you will find is that this has severe consequences on the market of how individuals behave, and in particular, what drives forces in the market. To give you a little bit of a background of who we are as Zacks, we are a wholly owned subsidiary of Zacks Investment Research, who might be a little bit more of a household name. We are the subsidiary of that, and they are typically known to provide research to investors in the form of analyst reports and the likes. So behavioral biases are, again, something very powerful, but we oftentimes forget. And there's a famous quote by Charlie Munger that kind of summarizes this. That is, if you want to succeed at investing, at some point he said you have to pick up these so-called tricks, he called them, including doing economics while knowing psychology. That is, you need to understand, obviously, what drives markets, what drives individuals, and why do they act the way they do. That is what exactly is forcing us to move in one direction versus the other. And again, as I mentioned before, one thing is in academia, we often think about this as an anomaly. That is, when individuals do something in a certain fashion, and that can be exploited. To give you an idea, the momentum anomaly has been around for many, many years, and that describes basically what the graph that we're seeing here. That is, we have a tendency that when my neighbor buys Apple and tells me that it did very well, then I'm going to go ahead and buy Apple as well. And I'm going to tell my neighbor on the other side the same story. And then this sort of perpetuates its way through the system. And that leads then to this effect that we're seeing here, that we're building bubbles. And that is something that we have sort of called an anomaly for the longest time. That is, in research, typically this is referred to as something that doesn't make sense, because it shouldn't be possible for me to look at the stock market return of Apple, or any stock for that matter, and just pick the top performing stocks, that is the top 10%, and buy them and consistently make money in this fashion. That is, in any other market around the world, think about real estate. If you just went around the block and bought the most expensive houses and hope that they will get even more expensive, that typically doesn't go very well. But the stock market tends to be an environment where these types of so-called anomalies continue to work. And one of the main reasons behind that is the aforementioned behavioral biases. And why are they so important? The main idea here is that I want to convey is that they can be detrimental to your returns. That is, one of the problems with that behavior is, while that may function as is, one of the main problems is that this causes a so-called behavioral gap in your returns, and the average investor suffers from this. That is, what we find is that the average investor has a huge gap between what they could achieve, that is typically the respective benchmarks, such as the S&P 500 is used as a threshold that you should be able to hit if you just simply bought that and held on to that, similar to what Warren Buffett suggested back in the day. But the average investor isn't able to make that, and that is something that is concerning. That is called the behavioral gap. That is, as an average investor, I should be able to just buy that and hold on to that, and I should be fine. But for some reason, we can't do this, and that can be attributed to this so-called behavioral gap. One of those, the results of this is, for instance, the market takes a hit, as we just witnessed. That is, we see this massive pullback due to the corona pandemic. And the very first thing we all do instinctively is we sell out. That is, we all get nervous. We all are worried that the world is going to come to an end. And you saw that happening at the end of February and beginning or throughout March. And this is exactly what is then causing this detrimental effect on our portfolio returns. And this is where we are then losing. And this is where it's important to stick to a disciplined approach. That is, I'm showing you here the study, or the results of a study conducted by the company Dalbar. They do this on an annual basis, where they compare the average investor's returns compared to the benchmark, the S&P in this case. And you see that for the equity investor and for the fixed income investor, there is a huge gap between. And often enough, this is something that I find interesting. You will find that the average investor is not aware of this. My father-in-law, for instance, oftentimes tells me that he's really good at calling market pullbacks. As he repeatedly tells me, I saw that one coming, I saw the other one coming, and I've been telling you we should be getting out of the market, and so far and so forth. What we forget, however, is how many times did we call the end of the world and didn't actually see that happening. So what we then forget is, for instance, not to criticize my father-in-law, but he's actually been out of the market for quite some time, since I believe right after the financial crisis, because he was concerned about what was going on at the time. And so you missed out on this phenomenal bull run that we have seen since, but you then walk around and you claim that you've been able to predict these pullbacks in the market. But what you forget is to compare your returns to what the average market return here does. And many, many investors do the same, commit the same mistake, that is we engage in this sort of mindset that we have been right about this. You know, the old adage, how 5 out of 3 economists predicted the last recession. That holds true typically for the average investor as well. That is, we predict these things, but we forget to compare ourselves to a benchmark. And that could be easily, again, the S&P 500, where we can simply say, let's just hold on to this thing and see what our average return would have been if we just held on to this. So JP Morgan conducted a similar study, came up with the same result. I'm just showing you this as a reference just for your information. But what exactly are ways of how we are affected by these patterns? I want to show you one study, or share a study with you, that I found particularly interesting because it goes back to that notion of how pattern recognition works for us. That is, as individuals, we have been trained from an early age, and also genetically, historically, if you go back into the development of human beings, we have been basically from early on successful if we were able to predict patterns or identify patterns. What food is good for us, what plants are good for us, which ones are poisonous. But in the stock market, that kind of fails us. That is, what we tend to do is we are particularly prone to recognizing patterns when we experience something called loss of control. And loss of control is a feeling that is relatable to something where you don't have entire control over. Think, for instance, of athletes. Athletes' performance oftentimes depends not only on their own skills and on their own performance, but rather on the opponent. And as a result of that, often enough, you find athletes believing in certain rules. That is, they have to have this bracelet on that day, or they need to wear that specific shirt that brings them good luck. And you know, you all have heard of these. Why is that so powerful among athletes? Because they are exposed to this type of loss of control a lot more than any other person. Because what happens here is, again, you could be very well prepared that day, but your opponent is just a little better prepared, or your team members are not pulling their weight, and then you might lose that day. So for that reason, we experience that a lot, and that causes then this sort of pattern recognition where you start believing that on the days when you're wearing your green socks, you perform much better than the other days. And there was an interesting study that basically replicated this. This was conducted at the University of Austin, Texas, where participants were split into 2 groups, a control group and a treatment group as usual. And both were given simple math problems like the ones you see down here. 2 + 2 is 4. And the control group was given actual feedback, whereas the treatment group was given random feedback, which means every now and then when they said 2 + 2 is 4, they were told that's actually not correct. Now, suppose you do this for half an hour. After half an hour, you're going to start thinking, I don't really get what we're doing here. This seems to be beyond my comprehension. I don't really get it. It seems like when I lift my right hand, then I'm right. When I lift my left hand, I seem to be wrong. You start seeing patterns. And afterwards, when both groups were shown pictures like the ones you see on the left here, these so-called white noise pictures, you might remember them from back in the day when you didn't have reception on your TV. The group that was experienced or primed to experience this loss of control was twice as likely to recognize patterns in there that weren't there. That is, they started recognizing things in there. And the same thing, and now you might say, how is that related to the stock market? The same thing happens in the investment world. Because we have so little control over it, that is, there are so many factors. The stock market return is at the end of the day a confluence of so many factors. You will experience this a lot, that you will do your research. You will have conducted all sorts of analyses to understand why that stock is a good pick. Take Tesla, for instance. But the very next day, Elon Musk sends out a tweet that sends the stock in the opposite direction of what you were predicting. And then you're going to start thinking, well, maybe I should have worn my green socks that day. So that is sort of one of those patterns or biases that subconsciously affect us without us knowing or noticing, and that's why they're so dangerous. So why exactly is it then so important? So understanding behavioral biases then allows us to overcome these economic outcomes, but it won't be able to solve this problem entirely. That is, we're still suffering from that problem. In a way, I always like to use the analogy that when I have a couple of drinks, I start thinking that I can sing. That's why I don't go to karaoke bars. The idea here is to say, well, I can't solve that problem, but I can circumvent that problem. And that's the idea here. That is, you're not going to be able to overcome these biases. None of us will be. We're all, be it professionals or retail investors, everybody is exposed to these biases, but the knowledge of them can help you overcome them. That is, you can be aware of the fact that you have, for instance, a tendency to hold on to losers too much because you don't want to admit that you were wrong. We all are. And that can help you then create a different selling decision to remove yourself from that process. And I will talk about this right here. So I wanted to give you a couple of brief examples, not to turn this into a lecture, but just to give you a brief idea of some of these biases and how they affect us. One of the first ones I always think is interesting, the conservatism bias that describes how much are we actually able and willing to accept new information as it comes in. That is, after I have picked a stock, say Tesla, I always like to use it as an example because it's like a belief-based stock. I either believe in it or not. I might afterwards read some unpleasant information about it, that it actually is not that good of a pick because it might be overvalued. It might not actually build a car at some point that flies to the moon. And the conservatism bias leads to us, or basically causes us not to pay attention to that. And I'll give you a personal example. I used to believe back in the day that I'm going to be a professional soccer player. And for the longest time, I would not talk to any, for that record, this is pretty much plan B for me. But for the longest time, I would not talk to coaches that would tell me the opposite. That is, I would refuse to listen to that simply because it was not in line with what I believed. And in that regard, we act in the same way when we review information, and we are not 100% aware of this. This is why this is dangerous. That is, you might actually think you've done your research, but in reality, you basically tend to have a tendency to not listen to anything that is not in line with what you're believing, analyst reports or any other information. Confirmation bias is a similar problem in the sense that we have a tendency to look for the things that confirm what we already know. In my example, I would talk to coaches that already confirm what I already know. And this is, again, something that we subconsciously engage in. To give you one example, there was a study that was recently, or a while back, conducted that asked individuals to count the number of articles that were either for or against the death penalty. And depending on individuals' personal views, they found more or fewer articles. That is, the number of articles that they found on this topic was highly correlated with their personal views. Now think about this. All you were asked to do is just count the number of articles that were for or against the death penalty. But if you are a strong believer in the penalty, then surprisingly, you're finding more articles. And this is dangerous because, again, we engage in the same problem that subconsciously we think we did our research, but in reality, we actually have sort of just confirmed what we already know. Status quo bias is something I find interesting because it relates very much to how we select stocks and think about other countries. I want to give you a personal example again. I moved here from Germany back about 3 years ago. I was born and grew up in Germany, and my family still lives there. And to this day, I haven't been able to convince my parents to buy US-based stocks because for them, this is an emerging market. This is the market where the financial crisis came from, and they simply don't feel comfortable with that notion. Whereas you might say, I've been only buying US-based stocks. What is their problem? So in that regard, we kind of stick to what we know, and we might miss out on many opportunities simply because, again, we tend to sort of feel more comfortable with the country that we were born in, the companies, because we know them better. And that is something, again, that causes investors to miss out on a lot of opportunities. With that said, I want to switch gears and move to something that is probably one of the most powerful biases in the world, and I think we all are familiar with it, namely emotional biases. Emotional biases refer in particular to loss aversion. That is, this is not news to anybody. Nobody likes losing, obviously. But something that was discovered a couple decades ago was that losing, in fact, elicits a feeling inside of us that is twice as strong as winning. What I mean by that is when we lose $100, the feeling is not as or is stronger than winning $100. That is, in particular, when losing money is something we attach so much personal value to, you can't say that you rationally make investment decisions because what you're going to be doing is seeing anything red in your portfolio is making you highly uncomfortable and act differently than seeing a winner. As a result of that, what happens typically when you ask an average investor if they bought two stocks, both at $100, one goes up to 110, one goes down to 90, what do? The typical answer is I sell the winner and I hold on to the loser. Why is that? Well, the loser still owes me money. That company entered a contract with me and they haven't delivered on that promise to get me a reasonable return. Now, in reality, you should say probably, well, the loser clearly doesn't work out, whereas the winner has something good going on. Hold on to the winner and let it ride. But as individuals, we have an opposite reaction. That is, we want to realize that gain really quickly, but that loser, that really hurts us. That is something that means we need to admit that we were wrong. That is realizing a loss. And that is something we cannot we are not comfortable doing. I'll give you one personal example. As I mentioned, I joined Zacks about 3 years ago. Now, suppose with me joining the portfolio management team, I am, say, for instance, very convinced that I need to make a mark, and I pick a certain stock that doesn't work out very well. Guess what I'm going to be doing? I'm going to be suggesting we hold on to that stock until it comes back, because my reputation is on the line. I'm sitting here and I push that stock to the portfolio management team, and everybody's going to say, well, great job there. And I'm going to be the one constantly arguing, hold on, it'll come back. But you don't want that in your portfolio. You don't want that type of mindset in your portfolio, because it is, again, very, very dangerous to your or detrimental to your returns, because again, we engage in emotional processes that push our decisions, and that's not something we should be doing. Rather, we should have some kind of systematic role that can help us overcome this. So in particular, I want to mention this because I spoke about momentum earlier. This is one of the reasons why momentum as a strategy works. That is, we have a tendency to hold on to losers for too long, and they, instead of just immediately correcting, they tend to sort of trickle through and fall further and further. That's because as individuals, we sort of slowly admit that we're wrong instead of immediately selling out of it. That is, I'm going to hold on to a stock that just dropped 10%, and then tomorrow I'm going to realize, well, maybe I should be selling it, and so far and so forth. You can see the opposite on the momentum side. That is, a stock jumping 10% immediately causes a number of individuals selling out of it instead of waiting until it actually hits the sort of justified new price. And that again causes this momentum strategy to work. So one more thing, and then I'll open the floor to questions or turn it over to you guys again. Market volatility can contribute to this, obviously. This is not a surprise to anyone. That is one of the things that Richard Thaler, he won the Nobel Prize 2 years back, I believe, or 3 years at this point. He found that individuals who check their portfolio more often actually underperform relative to the ones that don't check their portfolio. I always joke about the fact that the best thing that can happen to you is lose the password to your trading account, or lose the phone number of your financial advisor. That typically is the best thing that can happen, because what you do then is you just let it sit and work without you interfering and constantly making the wrong decisions. Because as individuals, whenever our emotions come into the process, we typically tend to hurt the performance rather than sticking to a systematic process. That systematic process, for the record, might be anything. It could be you rebalance every month because you look for new opportunities. You rebalance every week or even every day. But it needs to be something systematic that doesn't rely on you coming in there and saying, today I feel like rebalancing because the market is doing this or that. It needs to be something systematic, say, that you worked on together with your financial advisor, that might say the best thing is to do rebalancing. We rebalance every quarter or every year or not at all, whatever it is. But something systematic or rule-based, if you will. And I want to share one thing really quickly. This table, you might have seen this before, is showing you the average return of staying fully invested in the S&P starting in 1997 all the way to 2016. That is, you're not doing anything, you're just buying and holding all the way to today, and not today, but 2016. The average return would have been 7.5%, a little north of that. If you miss the 10 best days because you engage in market timing, and this is sort of the worst case scenario, but you can imagine that it happens very quickly. That is, for any reason, you might be easily able to miss out on this massive bounce back that we saw at the end of March this year, for instance. Your returns drop to 3%. Missing 20 best days, you're at 1.5%, and missing 30 best days even gets you in negative territory. And you can easily imagine how this can happen. That is, you think you have a system going, you think you can predict them, but very easily you might be able to miss out on very strong market days, because the market, remember, doesn't work like an interest rate. It's not a daily return that you accumulate, but rather massive pushes on one day, massive pullbacks on the other. So this average return that we always talk about of 7 to 8% is something that it happens over full market cycles, not something that happens over short periods of time. With that said, I want to say a few words about how to overcome this. Diversification obviously is your friend. One of the big issues is no matter how good of a stock picker you are, you're going to be exposed to something that you haven't been able to predict. Think of Johnson & Johnson with their baby powder scandal. Anything along those lines can always happen, even if it's a strong name. That is something, of course, that you need to diversify out of your portfolio. That is, if you really knew what you're doing, you should be only holding on to one stock, obviously. But because we don't know what we're doing, we need to diversify, and that's where diversification comes in. The second step here is, again, keeping in mind a diversified portfolio. In this case, I'm showing you the 60-40 allocation between stocks and bonds is a much smoother performance compared to just holding on to, say, stocks. in the long run, obviously, if you want to just buy and hold, you might say, well, I don't care about this. I have the stomach for it. But if you are an investor that is concerned about volatility, this would be one way to diversify that and smooth the performance in there. The second part, obviously, is stay the course. That is, the buy and hold strategy can outperform in general any type of in and out market timed approach, or this also includes the systematic approach. I think that's also still superior to any type of emotionally driven, let me just get out of the market right now because I've been hearing negative news. Any type of approach that is driven by this emotionally driven process is obviously prone to these type of errors. And finally, a manager with a long-term approach that embraces that idea is obviously important. This is something where, again, you can take advantage of the experience of your manager, of your financial advisor that has been doing this for a while and has been through a number of these up and down markets before, has been through, say, the financial crisis or the dot-com bubble, and has seen what these type of environments can do to a portfolio, but how quickly also they can bounce back in order to create a portfolio ahead of time that is well diversified in order to weather the storm, if you will. With that said, I'll stop right here and turn it back over to you, Elliot, or if there are any questions, and I'll take it from there. Thank you for your time.
Thank you, Metin. Let me ask you a question that was great. You know, we're talking about behavioral finance for clients. We are active portfolio managers here. We have repositioned all of our equity portfolios to take advantage of the health science trend, take advantage of the tech trend, take advantage of the what's called consumer staples like Costco and Walmart and Visa and MasterCard. We've done that, but clients are just pounded daily with negative news. It's rare to find positive news. I'm not talking about politics of CNN versus Fox. They're all very, very negative. And let's face it, negative news sells better than positive news. And these organizations are in the business of selling advertising, whether you're the New York Times or Fox or MSNBC, you sell advertising, and that's how they pay everybody. So given the fact that, you know, we've had a pretty good run up since the bottom now, most of our clients are positive for the year or close to it if they've been in equities. If their bonds are still not positive yet, because bonds are definitely lagging right now, how do they avoid this negative news mentally? It's a mental thing. It's like, oh my God, the world's coming to an end. How do they avoid that and say, Elliot, what are you doing? How do I do it? And I like what you're doing, which most of them do. But some of them I know when they go to bed at night are just downright scared that we're going to have another COVID outbreak next week. We're going to shut down the whole state of California or New York again. People are dying. Seniors are dying. Now young people are getting it. The world's coming to an end in the next 60 to 90 days.
That is an excellent question. And I'll tell you right away, I don't know the answer to that, but I'll say this. I can relate to this. My wife, a couple months ago, was having a similar conversation with one of her colleagues who was watching her retirement account, and every day with more and more negative news coming in, she was watching the decline in her retirement account. And I think it requires a lot of discipline, as you were saying, to be capable to consume those news, because I don't think any of us want to sort of completely shut off and not consume the news. I don't think that's the solution. But I think the important takeaway from this is, and you need to remember this, is that there is very little information in the news that you can actually trade, I would say. The old adage of buy the rumor and sell the news oftentimes holds true, that by the time it hits the news, it has oftentimes been already traded so many times that we're probably already reversing whatever is happening there. That is the main suggestion I would always have is, obviously you want to consume the news and pay attention to the news. I believe that is obviously important, so I wouldn't suggest to just turn it off, but do not think of that as a trading signal. I don't think anybody in their right mind would actually use this. I think there's a reason. I think the best example for this is, I'm pretty sure you guys are similar. Many financial advisors' offices that I've walked into typically have a Bloomberg TV or CNN or Fox News or what have you running in the background. But one thing that you might have already noticed is oftentimes the sound is turned off. Nobody's actually listening. The same holds true for a trading floor. I used to work at a stock exchange, and we had, all sorts of TV stations on with news, financial news on there, but the sound was always turned off. The main point was, you just want to see if something crazy happens. Other than that, you're not really paying attention to that. I think that's the best recommendation I can give. Pay attention to it. That is, know what's going on, what is driving the markets, but do not use that as a trading signal. We actually have many companies that are approaching us regularly with selling us sort of news sentiment, and we have tested this excessively. I can speak in that regard about a little bit about our research. We have tested this excessively. There's very, very little information that can be traded in that regard. That is maybe in the millisecond. You're all familiar with this. There are these algorithmic traders that immediately trade the second information hits the headlines. By the point in time when we open the TV or read the headlines, it's probably already over by probably hours. So in that regard, I would strongly suggest pay attention, but don't use it as a trading signal.
So I'll give you one quick sports metaphor, and I want to thank you for your time. So I've been a New York Rangers fan forever. Just for a big Eddie Jockman fan as a goalie. I turned out to be a goalie, played goalie for 40 years in various up and down and in and out ways. And I still have my teeth, although I'm running out of joints to be operated on at this point. But one thing I remember in the 1970s was the Boston Bruins they were the premier company. They took over for the Canadiens as the premier organization. And they had this incredible center named Phil Esposito. And Phil Esposito, instead of blaming or attributing to all their winning seasons, which they were just dominant force on, to great talent, to Bobby Orr, to so many great players on that team. Instead of attributing to that, when he was interviewed, he attributed to their winning streaks to the black turtleneck he wore when he played, and that he never washed it if they were on a winning streak. He only washed it when they lost a game. And he absolutely believed that. So he knew when he put that black turtleneck on, when it hadn't been washed, that they were going to win the next night. And
Perfect example.
Isn't that a type of behavioral finance?
Absolutely. Yeah, that's exactly what I was referring to. And I remember I used to play soccer back in the day. We had the same problem. We had, luckily enough, nobody believed in that one. Everybody washed their jerseys and everything, but it was the same problem and I have to do this kind of ritual every time before the game where I have to enter the court in this fashion with my left foot first, that kind of thing. We've all been there, seen it. And we all fall prey to it also. I have to say I'm the same way, especially sometimes in the market, the same thing happens and you sort of mentally think, well, maybe if I put my left foot on first, that will maybe cause the market to go up that day. So we've all been there.
Well, we do all have a level of OCD, I guess. So, Metin, I want to thank you very much. You've been listening to Metin talking about behavioral finance from Zacks. Thank you very much for doing that. We're going to let you go, and we appreciate that. And we're going to bring on our second speaker. So let's shift gears now. Let's get away from behavioral finance. We're going to continue the discussion with behavioral finance next weekend. Next Tuesday at the same time at 11 o'clock, as well as talking about socially responsible investing. You've heard what we're doing with portfolios right now. You heard how we're repositioning our clients to take advantage of trends in the market, to momentum in the market, which is technology and health science and biotech and companies that are solid like the Costco's of the world. And I don't mean to give a plug for Costco here. We're doing that. And we also want to let you know that we're going to continue that discussion ongoing. We've got 2 more episodes left of this and we'll take a break. But we're glad to have you here. So let's move forward here. We have a second speaker, changing gears. So the mortgage market, interest rates have basically collapsed in America. They've gone from the rates which were pushing 4% not too long ago on the mortgage market, just under 4, to in some cases almost half that. They're changing very, very quickly. Should I refinance my house? Are we heading for a collapse in the commercial real estate market, which I believe there's going to be a major pullback in commercial real estate, not necessarily residential real estate. But I know some areas of the country are already feeling it. The residential real estate is hurting. I have friends and family in New Jersey, and they're feeling it right now. So we have Rob on here, Rob Scott. He's from Finance of America. He's been a mortgage broker and a mortgage advisor for now 30 years. Like myself, he's a former bean counter, but he's a former CPA. And Rob, are you with us here?
I am.
Great, Rob. I'm going to turn this over to you and take it away and tell us, should we refinance? What's going on? Should I sit tight? Do I want to go into my retirement with a big mortgage in front of me, even though I could save money, but I could have a big nut? Or should I just sit pat? Tell us what's going on.
Okay, great. Thanks, Elliot. I appreciate you having me on, and we'll try to go through this whole thing. want to cover as much territory as I can, both historic and current relevance to what's going on in today's market. And this is kind of an idea, a little precursor of the items that I want to cover. You know, what does the current rate environment look like, and what do future projections look like? How specifically has the pandemic impacted the interest rates and the banking industry? What's been happening with real estate values and the real estate industry? I mean, most of us are homeowners, and that's a near and dear to our topic, to our heart topic. I'm beginning to hear a lot of people speculating and being concerned that we are headed for another major market correction in residential real estate, similar to what we saw in 2008. We're going to talk a little bit about that situation too. Pose the question, should I refinance right now? And if I do, what strategy should I employ? Or several of you might be entering the golden years of your life. You're retired. You're on reduced income. You'd like to take advantage of these interest rates? Can I qualify? What are my strategies there? And finally, I hear about reverse mortgages. I've kind of heard that might be the last ditch stand for a senior, but is that a strategy I might be able to employ? And what are the pros and cons of that sort of scenario? So let's start first with interest rates. This is a chart of the 2.5% mortgage-backed security coupon. And we go back to the beginning of January, right up through today. And basically what you're looking at here, each one of these candles is what we call them, represents a day. A green candle means that the price of the bond from the beginning of the day to the end of the day went up. And when the price of the bond goes up, interest rates come down. So on this chart, red is good, red is bad, green is good. Green is lower interest rates. And if you can see from the beginning of the year, we were on a really nice run here, getting lower interest rates. You know, there was some talk about, hey, pending recession that the economy is headed towards. The interest rate environment was getting very, very favorable. And if you look at some of these candles here, this was considered an enormous single day movement. And you can see for the most part, there's some movement, but it's pretty tame. Right in here, this is right at the beginning of March 9th, 10th, COVID outbreak, shelter in place, shut down the economy, social distance, all that stuff. And as you can see, things started getting really, really volatile. You know, the stock market, this is right when the stock market absolutely, the bottom fell out of it. You know, various banks had margin calls. They liked their mortgage-backed security market, but they needed liquidity. There was virtually no liquidity. They sold off and interest rates went all over the map. Well, the Fed comes in and they start to try to stabilize things, and they start purchasing mortgage-backed securities, and they got a little carried away. But since right in here is about where they started purchasing between $4.5 and $5 billion a day of mortgage-backed securities, they've really stabilized interest rates. And we're at a very historic low in terms of overall interest rates, as Elliot made the comment regarding. So really understanding what this interest rate market looks like and having some progressive projections on where we're headed from here is essential to understanding what our strategy is. Elliot gets very involved in managing the asset side of your balance sheet. Well, the liability side of your balance sheet is super important, and the biggest line item most likely on that liability side is your mortgage. So properly addressing and taking care of that is absolutely key. So COVID hits and it impacts banking tremendously. Liquidity is impacted, and risk factors in mortgage lending became that much more exaggerated. Your credit scores and the importance of good credit scores became exaggerated. Property types demonstrate risk. A condo, for example, is considered a more risk-laden property than a single-family residence. The occupancy of that property, if you're trying to buy a non-owner or investment property versus your principal residence, The investment property is considered much riskier. Higher loan to values virtually have gone away. And high debt to income ratios represent, hey, we're stretching ourselves a little bit further. That is a higher risk level. And as a response of the COVID-19 changes in the banking industry, they have tightened up on all of these areas. And there's a premium to be paid for crossing into some of these risk factors. The segment of the market in the mortgage world that has been most directly impacted by the COVID-19 is some of these more risk-laden products. Whether you're buying raw land or wanting to do construction, the opportunities for that have really diminished. Renovation loans. The jumbo market has been in a state of shambles now for a couple months, causing us to employ all sorts of different strategies to get up into the higher dollar amounts. Home equity lines of credit tied to the prime rate. Those have been impacted tremendously, and the margins that banks are charging has been changing dramatically. Leading up to the pandemic, we had what was called the flattening of the yield curve, which is simply a situation where a longer term yield does not provide the same kind of difference in interest rate or yield return as a shorter term. And so what happened is the comparative attractiveness of adjustable rate mortgages. You know, traditionally a 5-year fixed rate mortgage is maybe 1 full percentage rate lower than a 30-year fixed rate mortgage. In today's market, that yield curve has compressed so dramatically. Oftentimes 30-year fixed rate mortgages are priced more aggressively than the adjustable rate mortgages. So let's talk a little bit about where our real estate market is heading. You know, like I mentioned to you, I hear people talk about, hey, are we headed for another housing bubble? Are we going to see the bottom fall out of the market? I have prospective buyers that are opting to hold out on the sidelines, anticipating a decline in market values. There's a couple of fundamental factors and differences of what we are experiencing today and what we saw in 2008. And I'd really like to boil it down to a simple economic term of supply and demand. First of all, let's talk about what the demand is. This is a chart that represents over time the difference average age of young men and young women getting married. So you look at that and you say, okay, that's interesting. Yeah, that kind of makes sense with kids that I see over time. Maybe back in some of the older times, we were looking at, 20 and 21-year-old kids getting married, and now they're getting closer to 28 and 30. But why is that significant? Well, this is a chart that looks at that age group of 30 to 39-year-olds and their propensity for owning a single-family dwelling. SF here stands for single family, not living in San Francisco. So a married couple living alone without kids is nearly 40% of their 40% ownership. As soon as you enter in a kid, now all of a sudden neighborhoods, school systems, stability get that much more important. The incidence of home ownership of that demographic nearly doubles, more than doubles. And then if you look at this is the Google search engine for searches for baby registries over time. They started collecting this data in 2004. And as you can see, it has just skyrocketed. People who are getting ready to have children are doing Google searches for baby registries. And you can see that the number is clearly on the rise. Now, what does all that mean? You're talking about that demographic of people in their 30s to 40s who are getting married, starting families. The demand for housing is high given that. Now you look at where we were in 2008. Interestingly, the 33-year-olds of this Generation X, you can see this very flat area of population growth in the United States. Interestingly, right after Roe v. Wade passed. If you dial that clock forward 33 years, you land right at 2007, right at the beginning of the Great Recession. Now we dial the clock forward and we see what demographic is coming into the market that is going to be purchasing homes. And you can see nothing but increased numbers for housing demand. Now, that's the demand side of the equation. Let's look at the supply side of the equation. The absolute peak historically for inventory levels of residential real estate were met in, you guessed it, 2007. And you can see a tremendous decline as there was a correction that happened with the real estate values. And our current inventory situation is at all-time historic lows. So if you are interested in going out and purchasing a home and you talk to a real estate agent, they very well will say, hey, you know, there's some opportunity out there, but there is very, very little inventory, and it's a very competitive market. Supply and demand tells us if our demand is high and bigger than the supply, we will still see upward pressure on prices. So if we dial it, so then you look at it further and you say, okay, well, home builders are smart. They're going to address this lack of supply and they are going to build more homes. And after we saw the bottom of the real estate market in 2011, you can see this steady upward range. This is a chart of new housing start permits pulled by builders. Then COVID happens and you can see this sharp decline here in 2020, not projected to get back even to kind of normal curve levels until 2022. Bottom line is we are still suffering from a lack of inventory and supply. And as a result, we might have, there still is going to be quite a bit of demand and upward pressure on prices. Now, Elliot just made a comment about commercial real estate, and I think the changes that are happening in business fundamentally with being able to work from home very well might impact the commercial real estate market, but that's not what we're going to talk about today. Many of you probably own residential real estate, but probably not commercial. Now you look at the whole United States, just a little over a third of every household in the United States does not have a mortgage on their property. A little over two-thirds, just about two-thirds of the country has positive equity, and only 2% are underwater. If we were to look at the same pie chart back in 2008, 25% of the population were underwater. And another way to put that, out of 24 million households in the country, about 43 are rentals and about 80 million are owned properties. A third of them, again, own free and clear. 66% or 53 million homes have a mortgage, and their average loan to value is 53%. Loan to value is defined as take your mortgage balance, divide it into your property value, and it represents your equity piece. So the average equity is significant. Why is that important? One of the things that we experienced in 2008 was a flood also of inventory due to people being underwater on their mortgages, on their houses, and simply letting those houses go to foreclosure, causing an additional flood of inventory on an already over-flooded inventory market. And then you had the whole lending practices that led to numerous defaults. You know, you had your stated and no income documentation loans. You know, they lowered credit score requirements. They allowed for higher loan to values. They had artificially low payments instituted with negative amortization loans. And there's a place in prudent lending for all of these items individually. But when you add them all together, it creates excessive risk. And by that, I mean, if you are, let's say, a cash and carry business owner, and you make good income, but we can't document it, there's a place in prudent lending that says you could get a loan without even documented your income. Well, guess what? Your credit score requirements are going to be higher. You're going to have a lot more equity. That's prudent lending. Combining them all together, you create a storm that we saw that really led us into the housing bubble and the recession. So let's talk about recessions. The gray lines are recessions over the last 50 years. This one, and as you look, this is a chart that shows what happens to house prices during a recession. And in every case, not only during the recession, but shortly thereafter, we saw appreciation. Now, you might look forward to the 2008 recession and say, wait a minute, Rob, look at this. Remember, it was housing that brought us into that recession. And shortly thereafter, we did just fine. If you look at the time when you entered, if you were to buy right at the beginning of that recession, within 4 or 5 years, you were in positive equity territory. So just like the previous speaker just talked about, a staying power and not trying for a quick fix is important. Also, when you talk about recessions, interest rates tend to come down during recessions. If you look at all of these segments of time when we were in recession, we had significant interest rate drops. And all of those interest rate drops do nothing but spell further strength to the housing market because the affordability factor is higher. In fact, in our country today, even though the prices are as expensive as we feel like they are, the affordability factor, when you factor in the comparative price with the comparative income, real estate is as affordable as it has been in years. And you couple that with low and declining interest rates. So interest rates always come in peaks and troughs. And if you look at the trend that we've had since the 80s, the peaks are always a bit lower than the previous peaks, and the troughs are a bit lower than the previous troughs. And we have a trend going down. And if we dial this forward a little bit, our trough is now below this trough, spelling lower future interest rates. So if we feel that our property value isn't going to just drop out of the bottom, we feel that we have great interest rates, the $24 question is, should I or shouldn't I refi? The answer to that question is pretty simple. If you have an interest rate that is higher than current market value, you absolutely should refinance, unless your loan is so of a size that you can't do it economically. Let's talk about a couple of examples. There are different strategies that you can employ when you look to refinance, okay? You can say, you know what, I just want to lower my monthly payments. We need that for our cash flow. Things are a little bit tight. We stretched a little bit when we got into this mortgage, and I just need a lower payment to be more comfortable. Or, I have kids coming up that are going to school, going to college. We're going to have some additional, I want to take that cash flow. I want to make a cash flow play. You might be in a different mode where you say, hey, you know what? The cash flow isn't as important to me. I'm into the mode of wanting to reduce my principal balance as quickly as I can. I might be looking at retirement, and I'd love to be able to head into retirement without a mortgage. And these are the kind of strategies that you discuss with your asset and future wealth managers to create a strategy that makes the most sense for you individually going forward. The other idea is, ideally, we want to minimize the interest expense that we pay on that loan. So let's look at an example. Here's a $500,000 mortgage. There's really two key prongs that you can look at. You can look at a 15-year fixed. You can look at a 30-year fixed. A 15-year fixed is going to have a slightly lower interest rate. The general rule of thumb, the longer period of time that an interest rate is fixed for, the higher that interest rate is going to be. However, if you shorten the time that that loan is amortized over, your payments are higher. So your payment on this example right here, $500,000 mortgage, 2 7/8, 15-year fixed, monthly payment, $34.22. That same loan amount on a 3 1/4, 30-year fixed, monthly payment, only $21.76, $1,250 a month difference. That might be a material enough difference to make your decision as to which one of these strategies you employ. But let's go a little bit further. The interest expense on the 15-year in year one, $14,000. Interest expense in year one on the 30-year, $16,000. So what we're giving up in cash flow, we're paying for in additional interest. But here's the big number. Principal reduction in year one on the 15-year, $27,000. Principal reduction in year one on the 30-year, only $10,000. And here's the other striking note. Total interest to pay off the loan under the 15-year, $116,000 over that 15-year period. The total interest required to pay off the 30-year loan, $283,000. So if you're in the mode to say, hey, I want to liquidate my mortgage as quickly as I can, I want the lowest interest expense, I'm okay with the cash flows, that might be the strategy you employ. You might say, hey, you know what, I don't really have my college tuition taken care of for my kids. I'm better off taking $1,250 a month and investing it with Elliot's returns, given how low these rates are. And you know what, I'm willing to pay a little bit more in the long run to manage this now and take care of that. It all depends on the strategy that makes the most sense for your own individual financial plan that takes into consideration your income, your assets, and in your mortgage case, your liabilities. So people will also say, you know, I would refinance, but it just doesn't make sense because I have to pay all these closing costs. Well, closing costs are a given on a mortgage. You know, there's title and escrow fees that have to be paid. In many cases, you have to get an appraisal. There's just expenses and costs that are required to set up a loan. So let's look at an example here. $500,000 loan, $1 million home, 50% loan to value, 760 credit score. Let's look at a 30-year fixed rate loan, okay? Closing costs on a 30-year fixed rate loan, or on this size of loan, right around $3,900. So that's not a negotiable item. Closing costs are going to be charged on that loan. The question is, how do you pay for them? Well, you can finance the closing costs and add it to your loan amount and get an interest rate of 2.99, or you could just write a check for $3,900 and get that interest rate. If you wanted to say, hey, I don't want to have to pay that $3,900, let's leave my loan balance the same, nor do I want to write a check, I'm going to take a slightly higher interest rate. What does that look like? Monthly payment on the lower interest rate, $2,121, monthly payment, $2,176, for a difference of only $54.28. So then the question becomes, how long do I have to hold this mortgage before this $54.28 adds up to my $3,900? The answer to that question, really close to 6 years, okay? So what you are doing, if you decide, hey, I'm falling in love with this low interest rate, I'm willing to pay, I'm willing to finance it, what you're really saying is, I am guaranteeing, I'm putting a $3,900 bet on the table. It says, A, I'm absolutely going to be in this house in 6 years. B, I'm absolutely going to be in this loan for 6 years. And C, interest rates are as low as they are going to be in the next 6 years. I personally don't agree with that bet, but that's at least the wager you're making, and that's how those numbers pan out. I also hear some people say, hey, you know what, I would refinance, but I'm 10 years into my 30-year fixed. I'm well into that amortization period. I don't want to tack on an extra 10 years to my mortgage. Okay, that's a great question. It's a great point. Let's look at an example. Let's assume a same $500,000 loan, and let's say you're 7 years into that, okay? Your original loan amount was $500,000. You have an interest rate of 4.25%. Paying your regular monthly payments, you've amortized that loan down to $432 and some change, $432,000 and some change. Your current principal and interest on that loan is $2,459, and you've got 23 years left to pay that loan off. Here's the breakdown of that current loan payment, right? $1,532 is going to interest, $923 is going to principal. That's in this 23rd year. So now let's compare apples to apples. You propose a refinance. Do the lender credit option, so I'm not incurring closing costs. New monthly payment goes down to $1,883. I'm saving $576 a month, okay? If you're playing the cash flow game, you might say, hey, I'm gonna take that $576 a month and I'm gonna use it either in my monthly budget, I'm gonna invest it, I'm gonna let it, whatever it is I'm gonna do. But here's the breakout of how those monthly payments are broken out between interest and principal. You see a lot less interest is being charged, but we're not paying down as much of the principal. So this is where that concept says, hey, you know what? Adding 7 more years to that loan amount doesn't make sense. Here's how the math works. If you take and make your old payment on the loan, on the new loan, you would pay the loan off in 239 months, 37 months sooner, and you'd save $91,000 in interest. So just by making that one move, you aren't resetting your payoff or extending your payoff, you're shortening your payoff, you're keeping your payments the same in that scenario and saving $91,000. So should I refinance? Absolutely. Should I apply the right strategy in a refinance? Absolutely. Now, some of you might be in a retired or fixed income kind of a scenario, and you might have concerns and say, hey, I do want to refinance and take advantage of these lower rates, but I'm concerned about my ability to income qualify. Okay, I can still use my Social Security. I might be getting a pension. I've got a 401k hanging out there. I've got investment accounts that allow me, depending on what my individual circumstance is, I can potentially take discretionary distributions if I so choose. While my Social Security and my pension income might not be enough for me to qualify, I have some other discretionary distributions that I possibly could coordinate. When I work with a wealth advantage manager like Elliot, we get our heads together and we say, okay, I need another, say, $10,000 a month in order to qualify for the mortgage that I'm interested in. The rule is I need to only show, as long as I have access to that money, I only need to show one distribution to establish that order. And the amount of asset that I have to have has to be sufficient to last for 3 years. So under that example, if I were to take a $10,000 a month distribution, because that's what I needed to qualify for that loan, nothing that says I have to take it in the future. I just have to have $360,000 in that account, and I've effectively managed to get myself some income that I can qualify for that mortgage. Now let's say that you're considering possibly eradicating a mortgage payment altogether, and you're considering a reverse mortgage. A reverse mortgage is simply a mortgage that accrues interest that is deferred until the time you liquidate that loan. Seniors who are over the age of 62 can qualify for this program. We have some programs that allow seniors over the age of 60. It's for your principal residence only. You can take out the proceeds in a number of different ways. You can, like we talked about a minute ago, you can liquidate an existing mortgage and get rid of the debt service. You can pull out, if you own your house free and clear, you can pull out cash as a lump sum, and you could use that to your discretion. If you wanted to beef up your account in your wealth management, you could. If you wanted to take some and have a inheritance planning strategy or a gift to a grandchild who's looking to buy a home, you could. There is no restrictions as to what you do with that money. Interesting component of a reverse mortgage, it's a non-recourse debt. So basically what happens is that principal balance adds and accumulates interest over time. So your loan balance grows. If you still live in the property and the loan balance grows and exceeds your market value of your property, that difference is not owed by you. That's a really important concept. The ownership remains with the senior. And the senior can stay in that property as long as A, it's their principal residence, B, they're maintaining the property taxes and insurance, and C, they are maintaining the property satisfactorily. Interesting other option here, you can use a reverse mortgage for a purchase transaction. Let's say that you are downsizing from the family house. It's just too big, the yard's too big, upstairs, downstairs, my niece can't handle it. I, like Elliot, I'm running out of joints to have operated on, and so I don't like going up and down the stairs. So we look at it from a senior with a lot of our seniors, we don't look at it as downsizing, we look at it as right sizing. So perhaps you're looking for a single story property, get rid of the family house, easier to maintain yard. We can sell this, we can pocket, but we really don't want to tie up all of our resources in this new purchase. You can use a portion of that to put up for your down payment, use the other portion financed with a reverse, avoid having to make mortgage payments on that, and move forward owning that property. You can also obtain an equity line option that does not accrue interest until you actually withdraw on it. It is waiting there in an account for your withdrawal. And you can use that for greater flexibility. So now, a reverse mortgage is not a perfect thing in the perfect world. It's not for everybody, but here's some of the pros. Your retirement assets might last longer, and the amount that you have to withdraw out of those assets would be less, potentially allowing you to utilize the equity in your home for living expenses, and it might change the quality and enjoyment of your life. The home ownership, as we mentioned, it remains with not only the senior, but the estate. It's treated just like a lien that needs to be paid off at the end. And it enables the senior to live in the home through the rest of their life. I just closed a reverse last week, and the woman, dear sweet woman, she says, you know, I can rest easy because I know I can be where I want to be for my last days. It was really a special moment she shared with me. She says, I don't fear dying. I fear the uncertainty of where I'll be as I head into my final days. Another option that you can use in coordination with your funds that you have with Elliot is the credit line option that I mentioned. A lot of savvy seniors are setting up credit lines and then using them strategically to avoid liquidating part of their portfolio in down times of the market, when it's inopportune for them to take risk and take those funds out of the table, or off the table, excuse me. All right, so what are some of the cons? If you have an existing mortgage, depending on your age and your property value, that new loan amount limit that they provide for you might not be sufficient to completely pay off your mortgage. It can be more expensive to obtain a reverse mortgage. There are some closing costs, and it's very difficult to do a lender credit sort of option entering in. The interest rate is higher than on a conventional mortgage. We're talking conventional mortgages are in the 3s, reverse mortgages are in the 4s. We're not talking 8, 9, 10 or anything like that. But the bottom line is, and there's some thoughts going around that banks are looking to prey on seniors, take their homes from them. Nothing could be further from the truth. So anyway, that's about all I have right now. Elliot, thank you for allowing me to present some ideas. If you have questions, I'd be happy to entertain them. If you want to have personal questions, if you don't feel comfortable airing them over the broadcast, feel free to reach out to me personally. I'd be happy to answer any questions, whether over the phone or via email that you like. And Elliot, my guess is you've cooked up a couple questions for me.
I do. Rob, thank you. That was just great. I do have one main question here. If you do want to reach Rob with questions, give me an email and I'll forward them to Rob. Elliot, ELLIOT, at Prosperity, F as in Frank, G as in George, prosperityfg.com. Also, our website is www.prosperityfg.com. This is great. And if you have any comments that you want to give to me, please give them. I am wearing the shirt, custom shirt, the color of wine. Let me know what you think. We're all trying to do things right here. And again, next week's version, Rob, before I ask you a question, I want to tell everybody we're going to continue at 11 in the morning next Tuesday with the discussion of behavioral finance and why people make decisions they make, particularly why they always make the wrong financial decision at the wrong time. And we're going to talk about environmentally social governance funds or ESG funds, or why people invest, why people should invest in these, or should you really put your money where your mind is versus money where the business is going. We're going to have a good debate with our friends at Deutsche Bank on that, or DWS. So Rob, here's a question that's come up a few times. And that is that, you know, here we live in the East Bay of San Francisco, East Bay of Oakland, and we know more and more people are working out of their house, which tells me they're not going back to their office. That's the new change, the new reality of what may be happening. So is that going to drive demand up here for suburbs and the millennials, so to speak, to get out of the city and want to live in a nicer area with a nicer home?
It absolutely is. That's a really great question. In fact, I had a couple slides originally in this presentation that talked about the demographic. Basically, the under 35s are fleeing for what we call the exurbs, the suburbs and the further out even. They're finding that they like the quality of life, they like the social distance better, they like their own space. They're away from the urban hustle and bustle, and especially as we talked a little bit about as they start having families, school districts, neighborhoods, kids to play with in the neighborhood, life experiences are all more important than the craziness and hubbub of the urban living scenario.
Great. So we've been listening to Rob Scott. We've gone on a little bit longer than we usually go on because we had two great speakers today. Thank you for being part of it. If you want to send me a question, it's Elliot, ELLIOT, at prosperityfg.com. If you'd like to talk to one of the advisors, Jamie or Emmett or myself, just give me a holler and we'll forward that your information to them and set up a personal Zoom meeting, a personal one-on-one meeting. Whatever works, we are beginning to do one-on-one meetings in our office. And of course, Zoom is, I guess this is what we're going to be doing for a long time. So on behalf of Prosperity Financial Group and your speakers today, I want to thank you for being part of this. We look forward to seeing you next Tuesday morning, and have a great day.